David Ramsey has helped millions of people get out of debt. He's been doing it for over 30 years. He has a radio show, a podcast, books, and a whole company. His number one rule is simple: debt is bad, get rid of it, all of it. Welcome back to another episode of Almost Wealthy. I'm John, and I borrow money on purpose every single month against my investment portfolio to pay my bills. So today I'm going to show you exactly what Ramsey says about that, and then I'm going to show you the math that he never runs. Real quick, here's where everything stands. The Freedom of Time portfolio is at $8,834.23 right now. I started this portfolio in March 10th at $0. Less than 2 months, I'm up $602.15. That's an 8.57% gain. The portfolio has paid out $64.08 in dividends so far, coming from all my holdings. Now, here is the part Ramsey would hate. My loan balance is at $242.76. This is the margin loan covering my phone bill. My loan to value is around 2.75%. My personal safety limit right now is at 12%. A margin call doesn't even trigger until 40%. I have 37 percentage points of room before anything bad happens. The dividends I'm earning are already more than covering the interest on the loan. The strategy is doing what it's supposed to do. Now let's talk about why the most famous personal finance guy in America will call this stupid. If you ever Googled how to pay off debt, you've probably seen David Ramsey. He is one of the most listened to voices in personal finance in America. He has a radio show, popular podcasts, YouTube, best-selling books. His famous book is called The Total Money Makeover, which I've read, and it's a pretty simple book. His core system is called the 7 Baby Steps. The idea is really simple. Stop using debt, pay off everything you owe, build a cash cushion, and then start investing. Pretty much in that order with no expectations. His audience loves him to death. And for the people that's drowning in credit card debt, car loans, student loans, his advice works. I'm not here to say Ramsey's a fraud or bash him. He's definitely not a fraud. He has helped real people turn their finances around, but there is a big difference between escaping the debt trap and using the strategy debt to build wealth. Those are not the same thing. Ramsey treats them like they are, and that's where I disagree. Now let's give you some of his actual words. Ramsey says you can't be in debt and win. It doesn't work. He also says investing is important, but get debt free first. That's what frees up your income so you can win. And borrowing to invest, he said, listen to us, never borrow money to invest. That is a direct quote about margin loans. He is specifically talking about what I am doing. Now, here's the most extreme version of his position. Someone asked him, what if someone offered you $1 billion at 0% interest for 10 years? $1 billion for free for a decade. His answer was, I don't borrow money. He turned it down in the hypothetical. Not even $1 billion at a zero cost could change his mind. That tells you everything about how deeply he believes this. Now, here's what that belief comes from. David Ramsey didn't start out preaching against debt. He started out borrowing millions of dollars to buy real estate. He was heavily leveraged. He was betting that the prices would keep going up. They didn't. The market shifted. His lenders called in for the loans. He couldn't pay them back. In 1987, David Ramsey filed for bankruptcy. He lost everything. That's the event that became the foundation of every single thing he teaches. He decided at that time that debt destroyed him and that debt would never touch him again. I get it. That's a real story with real pain behind it. The debt that bankrupt Ramsey and the debt I'm using are not the same. They're not even close. Now, here is something that Ramsey never talks about. His baby steps say, pay off all the debt first, then start investing. For a lot of people, paying off their debts takes years, 3 years, 5 years, sometimes even 7 to 8 years. Every year you wait to invest is a year of compounding you'll never get back. Say you have $500 a month to work with. If you start investing that $500 today and you earn 7% a year for 30 years, you end up with $567,000. Now, say Ramsey tells you to spend the first 5 years paying off debt before you invest, same $500, same 7%, but you start 5 years later, you only invest for 25 years instead of 30. You end up with about $378,000. That 5-year delay cost you $189,000. You didn't make any bad investments. You just waited. Gone because you followed the rule. Compound interest has one requirement: time. The longer you wait, the more it punishes you. Ramsey systems cost people years, and those years have a real dollar price. Now, let's run the side-by-side comparison using the same exact numbers. My monthly take-home pay is around $7,400. My total monthly bills are around $3,300. Rent, utilities, food, phone, insurance, all of it. Now, Ramsey's way says pay those bills with your paycheck. That's the standard approach. Pay the bills first, invest whatever is left. The buy, borrow, die way says borrow to pay those bills. I take out a margin loan against a portfolio every month to cover the $3,300. My full paycheck is around $7,400 that goes to the portfolio. That is the only difference between these two approaches, where the bill money comes from. The Ramsey investor puts $4,000 a month to work. The buy, borrow, die investor puts $7,400 a month to work. The gap between that is around $3,300. Now let's say what the gap becomes over time. At 7% annual returns, a realistic and conservative number, that's an extra $3,300 a month that compounds to about $581,000 over 10 years. Now, if you look at this over 20 years, it grows to approximately $1.75 million. That is what it costs to pay bills from your paycheck instead of borrowing against your portfolio. In my situation, with the exact same numbers. Now let's talk about the loan cost. My borrow rate at M1 is 5.65% a year. For right now, my loan balance is $242.67. Annual interest on that right now is about $13.71, and it's about $1.15 a month. My portfolio is generating dividends at a pace that projects a roughly $384 a year. The dividends are covering the loan costs 27 times over right now. Now let's zoom out to phase 10 when all of my bills are on margin. The total monthly bills will be around $3,300 and about $40,000 a year. At the level of borrowing, the annual interest rate at 5.65% comes out about $2,200. My portfolio needs to be at $147,000 to support phase 10 safely. At $145,000 with a 5.23 blended yield, I'm earning around $7,500 a year in dividends, $2,200 in interest. The dividends cover the interest more than 3 times over. The loan pays itself. My paychecks keep compounding. And that is the math that Ramsey doesn't want to run. Now let's talk about Ramsey's investment advice. He tells people they can expect 12% average annual returns from mutual funds. He uses this number in all of his retirement projections. Invest after you're debt-free. Earn 12% a year. Retire a millionaire. The problem is that the 12% is not real. It is a math trick. Here's what Ramsey does. He takes the S&P 500 annual return year by year. He adds them up. He divides by the number of years. He calls that your expected return. Here's a simple explanation. Year 1, your portfolio goes up 50%. Year 2, your portfolio goes down 50%. That's an average of the 0%. But you started with $100. After 1 year, you have $150. After 2 years, you're down 50%. You have $75. you lost $25. That's the average of 0%. Reality said negative 25%. The gap is called variance drag, and it gets worse the more volatility the returns are. The real long compounding returns for broad market index funds is closer to 7% to 10% in the normal terms, not 12%. And a research firm called Dalbar has been studying what real investors actually earn in their accounts for decades. The numbers, 3.66 on average over 20 years, not 12. And that 3.66%, part of that is behavior. People panic selling, and when the market drops, they miss the recoveries. But the point is that Ramsey builds his retirement math on the numbers that almost nobody actually experiences. I use 7% in my projections. It's conservative, it's realistic. And even at 7%, the buy, borrow, die strategy approach beats Ramsey's approach by $1.75 million over 20 years in my situation. His 12% assumption is doing a lot of work to make his system look better than what it actually is. So what happens to a margin loan if you drop 30%? So let me answer that with actual numbers. Right now, my portfolio is around $8,800. My loan is $242, around 2.75% in LTV. If the market drops 30%, my portfolio falls about $6,100. My loan is still $242. My LTV goes up from 2.75% to 3.93%. Still nowhere near a margin call. A margin call at M1 Finance doesn't happen until I'm at 40%. If the market drops 90%, my LTV would be 30%. Still no margin call. The real reason this works is the LTV I'm targeting. I'm keeping it safe at 12% right now and below. That gives me a massive safety margin cushion against any crash. Ramsey went bankrupt because he was over leveraged at levels where a market shift would wipe him out. I'm running at a 2.75%. The strategy only breaks if I borrow way more than I should. That's why I followed the phase system. One bill at a time, one phase at a time. Never get too greedy with a loan. Risk managed is not the same as risk eliminated. But the 2.75% LTV with a 40% margin loan call threshold is not a reckless bet. It's a calculated one. When Ramsey went bankrupt, here's exactly what happened. He borrowed enormous amounts of money to buy real estate. That real estate produced little and no income to cover the loans. He was betting prices would keep going up. When they didn't, his lenders called in for the loans. He had to sell at the worst possible time. He got wiped out. That is bad debt. Borrowed against speculative assets. No income to cover the interest. High leverage. No safety margin. No liquidity. My loan is $242 against a $8,800 portfolio. 2.75 LTV. My assets are dividend-paying ETFs. They generate income every single month. That income covers the interest on the loan. My ETFs are liquid. I can sell them the same day if I needed to. Ramsey couldn't even do that with real estate. I'm not speculating. I'm not borrowing, hoping that SCHG doubles next year. I'm holding it for the dividends and long-term compounding and growth for 20 to 30 years. The word debt appears in both stories. Everything else is different. Calling what you're doing the same thing that bankrupt Ramsey is saying a home mortgage and a payday loan are the same because you're both borrowing. They're completely different realities. Here's the interesting part. Ramsey was once pressed on strategic borrowing. Someone laid out the math for him, and he said mathematically it might make sense. He acknowledged it. He admitted that the math can favor what I'm doing, but then he said he still wouldn't do it because of 1987 bankruptcy. And I understand that. It's really not about the math. It's about what he's willing to risk after what he went through. That's a personal choice. and I respect it. But your personal choice doesn't have to be his. If you have high interest consumer debt, Ramsey is right for you. Pay it off. Stop the bleeding. Start investing clean. But if you are past that, building a portfolio on purpose, keeping your LTV low, letting dividends cover your interest, the math says something different. And Ramsey himself acknowledged that math. He just chooses not to follow it. Ramsey's not wrong. He's wrong for the wrong person. His system helps people escape bad debt. The buy, borrow, die is a system for people who are past that, who want to use low cost, low producing, strategic debt to compound their wealth faster. The difference of my situation in this was $1.75 million over 20 years. That's not magic. That's just putting your whole paycheck to work instead of half of it. I'm testing that out in real time with real money every week. If you want to follow along, subscribe. I post every week with real numbers. I'll see you on the next one.